Welcome to the research desk.
Glad to be here for this one.
Yeah, let us set the scene here slowly and deliberately, because the context is everything. The date is February 28, 2026. A massive, multi-front war involving Iran begins. And the global stage immediately presents every classic textbook ingredient you could possibly have for a systemic financial panic.
Oh, absolutely. The whole board lights up red.
Exactly. We see crude oil spiking violently on fears of constrained supply. We see the specter of runaway inflation returning with an absolute vengeance. And, we see this intense localized Middle East geopolitical panic threatening to just spill over into global supply chains, blockading critical shipping lanes, completely paralyzing international trade.
It was the perfect storm.
It really was. And for decades, right, financial theory, institutional modeling, even just ancient market tradition, they've all prescribed a singular, automatic response to this exact alignment of systemic threats. Investors are taught to buy gold. So what actually happened? Think about this for a second. The ultimate historical safe haven, the asset universally trusted to protect capital when missiles fly and inflation surges, crashed roughly 20%.
Yeah, a 20% crash in the middle of a war panic.
Right. So my position today is that this dramatic price action was a temporary first-wave liquidity flush. It proves that gold is now a second-wave macroeconomic hedge, not a broken asset. It hasn't failed, it's been demoted from an instant responder to a post-flush hedge that will eventually reassert itself once the macro regime shifts.
Well, I hear that. But my contrasting position is that gold's traditional branding as an automatic war hedge is structurally broken. Its first responder status is just gone. Institutional capital has permanently shifted the safe haven crown to the U.S. dollar and short-duration treasuries. They demand liquidity, yield, and collateral quality, and gold just doesn't offer that in a modern panic.
I think the data tells a slightly different story over a longer timeline, but let's get into the actual anatomy of that February 28th shock, because we need to find some common ground on what mechanically happened.
Right. If we are going to look at the anatomy of that shock, we have to begin with the absolute dominance of the U.S. dollar in modern market plumbing. We observed the U.S. dollar index, the DXY, rise sharply from 97 to 100 the exact moment the conflict initiated. And this is not merely a price movement on a screen, right? We need to explain exactly how that functions.
Let me pause you right there, because I really want to make sure we completely unpack that mechanic. Why does a 3-point move in the DXY functionally choke the system? Because, a lot of people see the dollar go up and just think, oh, it makes imports cheaper. But for institutional capital, it is fundamentally different.
It's entirely different. It is a systemic bottleneck. The plumbing of the global financial system requires U.S. dollars to settle trades, to meet margin calls, and to service dollar-denominated debt. We're talking about trillions of dollars of corporate debt globally, issued in U.S. dollars by entities that do not generate U.S. dollar revenues.
Like emerging market corporations?
Exactly. So when a geopolitical shock hits, credit markets freeze, companies and sovereign entities panic because they suddenly realize they might not be able to roll over their dollar debt. So what do? They scramble to hoard cash. Dollar liquidity, not bullion, becomes the immediate refuge. Because gold is priced in dollars, a stronger greenback mathematically suppresses the value of dollar-denominated gold. If you have a finite amount of global capital, and it is all rushing to secure U.S. dollars just to survive the clearing process, the bid for gold just vanishes.
Which introduces the currency penalty for non-U.S. buyers. Think about it. If I am an allocator in Europe or Asia and I want to buy gold to hedge against the Iran war, I am taking a massive currency risk. I have to convert my depreciating local currency into appreciating U.S. dollars just to buy the gold. The exchange rate penalty destroys the protective value of the hedge before I even take possession of the asset.
That is the mechanical reality. But it goes deeper into how institutional money prioritizes collateral. In a fast-moving shock, allocators demand assets that settle instantly and can be posted to clearinghouses without steep haircuts.
Let's quickly explain a haircut in this context for people.
Right. So, when a massive financial institution enters a derivative trade, the clearinghouse demands collateral to guarantee the trade. If you post U.S. Treasury bills, the clearinghouse treats them as cash. Zero haircut. If you post gold, the clearinghouse looks at the volatility of the asset and says, well, we will only give you 80 or 90 cents of credit for every dollar of gold you pledge.
Wow, yeah.
And in a crisis, when every single dollar of liquidity matters, taking a 10 or 20% haircut on your collateral is institutional suicide. Gold generates zero carry while you wait out the storm, and its collateral status is strictly secondary. If portfolios are still treating gold as the default geopolitical hedge in an environment where the dollar is the ultimate systemic bottleneck, they are fighting the last war. The market no longer asks what asset is safe in historical theory. It asks what asset absorbs panic first and funds immediate liabilities.
Look, I see the structural demand for dollars, and the collateral argument is mathematically sound. I'll give you that. However, I frame the suppression of gold during this specific February window around a totally different mechanism, and that's the yield poison introduced by the macroeconomic environment.
The yield poison?
Hawkish, holding the federal funds rate at exactly 3.50% to 3.75%. That is the critical threshold that dictates everything else.
Explain the mechanism of that threshold. Why does the Fed holding at 3.50% to 3.75% matter more than a major war in the Middle East?
Because it dictates real yields, which are the absolute gravitational pull on gold prices. A nominal yield is just the stated interest rate on a bond. The real yield is that nominal yield minus the market's expectation for future inflation. Because the central bank maintained a restrictive 3.50% to 3.75% posture in the face of an inflationary supply shock, the bond market aggressively repriced its expectations. It looked at the Fed's resolve and immediately priced out all 2026 rate cuts.
Right. The market realized no help was coming.
Exactly. Traders realized the Fed was not going to print money to save them. The Fed was going to hold rates high to fight the oil-driven inflation. That dynamic pushed real yields significantly higher. And higher real yields are absolute poison for a non-yielding asset like gold. Treasury bills provide compound interest. Physical gold provides nothing. When an allocator can earn a risk-free, compounding yield north of 3.5% while waiting for geopolitical clarity, the opportunity cost of holding a zero-yield commodity becomes mathematically prohibitive for algorithmic and institutional capital.
The opportunity cost you are describing was certainly the catalyst, but the sheer severity of the liquidation, that 20% crash, was a function of speculative froth. We have to look at the positioning data heading into the conflict.
The positioning was definitely heavy.
Heavy is an understatement. Gold had already rallied an astonishing 66% in 2025. Furthermore, we tracked exactly $10.5 billion in ETF inflows in just January and February 2026 alone.
Right, let me jump in to clarify how those ETF inflows actually function, because this explains the violence of the crash. When $10.5 billion flows into a gold ETF, the authorized participants for that fund have to go into the market and buy underlying physical gold or gold futures to create new shares. It creates a self-reinforcing liquidity loop on the way up. But this was not pristine, long-term safe haven ownership deployed by strategic allocators. This was a crowded momentum trade masquerading as geopolitical insurance.
And when the war shock occurred on February 28th, it failed to immediately precipitate a systemic global financial collapse. The global banking system did not freeze in the first 48 hours. The vulnerabilities of that massive, crowded positioning were instantly exposed. This is where the mechanics of a margin call dictate market direction.
Walk us through that cascade.
Okay, picture a massive multi-strategy hedge fund. They own technology stocks, they own corporate bonds, and they own a massive position in gold that they bought during that $10.5 billion inflow wave. The war starts. Their technology stocks tank. Their corporate bonds tank because of the inflation fears you just mentioned. Suddenly, their prime broker calls and says, your portfolio value just dropped below our risk threshold. You need to wire us $500 million in cash by 4 p.m. today, or we are liquidating your entire fund.
And the fund obviously does not have $500 million in cash sitting around.
Exactly. So what do? They look at their portfolio. They cannot sell their tech stocks because there are no buyers. They cannot sell their corporate bonds because the spreads have blown out. They look at their gold holdings, which are highly liquid and perhaps still holding some value from the 2025 run-up. They hit the sell button. They do not sell gold because they hate gold. They sell gold because it is the only asset liquid enough to raise the cash to save their broader portfolio.
Which just triggered a bloodbath.
That forced liquidation triggered a historic cascade. We saw the worst week for gold since 2011 at negative 9.6%. We saw the worst month since October 2008. Ultimately, it was the largest weekly dollar decline on record. This is what happens when you have insurance sold by tourists. When everyone owns the exact same hedge, it ceases to function as insurance. It becomes inventory, highly vulnerable to margin calls and sudden deleveraging.
The ferocity of that deleveraging, the exact margin call cascade you just detailed, is why we must look at the historical precedent of March 2020. The COVID funding squeeze provides the perfect architectural template to prove that gold's behavior in February 2026 is a feature of market structure, not a structural failure of the asset itself.
Okay, let's trace that.
Let us trace the narrative arc of that specific crisis. It is early March 2020. Panic hits the global system as borders close. A severe, unprecedented global funding squeeze materializes overnight. Institutional allocators face the exact margin calls you just described, but on a global, synchronized scale. In mere days, spot gold falls from above $1,670 an ounce to below $1,470. That was a violent drop of more than 12%.
And during that exact window, the US dollar surged wildly.
It surged precisely because investors were forced to sell what they could, rather than what they wanted to sell. Margin calls completely overrode every elegant safe haven narrative. It looked for a brief moment in late March 2020 as though gold had catastrophically failed its primary mandate as a crisis hedge. The financial media ran the exact same headlines we saw in early March 2026.
Sure, gold loses its luster, all of that.
Exactly. But then we saw the reversal. The Federal Reserve stepped in, cut rates to zero, and flooded the system with trillions of dollars in liquidity. Real yields absolutely collapsed into negative territory. Consequently, gold reversed violently. It did not just recover, it broke out, surging above $2,000 an ounce by August of 2020. The lesson from that sequence is fundamental to understanding market mechanics. In stage 1 of crisis, liquidity beats mythology. Gold is the post-flush hedge, the dollar is the first responder. You have to survive the margin call flush before the true macroeconomic hedge can express itself.
I listened to that 2020 narrative, and I acknowledge it is clean. It makes logical sense if you assume central banks will always act the same way. But let me offer the 1980 Volcker parallel.
The Volcker parallel, okay.
Yeah, this historical arc demonstrates why relying on a dovish policy rescue, the post-flush thesis you are outlining, is an incredibly dangerous assumption for capital allocators. Let us look at January 1980. The Iranian Revolution has occurred, and the subsequent hostage crisis dominates global headlines. Spot gold pushes above $800 an ounce. To the market at the time, this seemed to be a spectacular, definitive validation of the classic safe haven script. Geopolitical turmoil was translating directly into a massive gold rally.
The correlation seemed absolute. War equals gold going up.
It seemed absolute. But then, Federal Reserve Chairman Paul Volcker recognized that systemic inflation was destroying the U.S. economy. He did not flood the system with liquidity. He drove real rates sharply, violently higher to break the back of that inflation. As a direct result, the dollar strengthened and the global market aggressively rediscovered the power of positive real yield. Gold fell more than 50% from its peak by mid-1980.
Wow, 50%.
More than 50%. And think about that time frame. By mid-1980, the geopolitical drama in the Middle East was ongoing, unresolved, and severe. The hostages were still held, the tension was palpable, yet gold lost half its value. The lesson here is absolute. Macro regime beats geopolitical drama when the two collide. In 2026, the Federal Reserve, holding at 3.50% to 3.75%, acted as the macro regime superseding the geopolitical shock of the Iran conflict.
I want to push back on how you are framing the Volcker era relative to today because the debt levels are entirely different. But I will let you finish the thought on how this dictates institutional behavior first.
Well, thank you. Because this historical context, both the failure in 1980 And the mechanics we saw in 2026 establishes the new tiered hierarchy of how institutional money actually operates today. It is not a binary choice between gold and stocks. It is a strict three-tiered defense system.
Lay out the tiers.
Tier 1 is USD cash and short treasury bills. These instruments settle instantly and can be posted as pristine collateral without those haircuts we discussed earlier across the entire global financial system. Tier 2 is duration. These are longer-dated treasuries which catch a bid only if the market assesses that recession risk dominates the inflation risk. Finally, Tier 3, at the very bottom of the institutional defense mechanism, is gold. It serves only as a later-stage monetary hedge. Consider the analogy of a real fire drill in a crowded high-rise office building. When the alarm sounds, the strobe lights flash and smoke starts filling the hallways. People do not stop in the corridor to debate the architectural integrity of the building. They do not pause to discuss the long-term resilience of the concrete foundation. They run to the nearest illuminated exit that they know mechanically works. In 2026, that exit is T-bills and the US dollar. Gold is just a fireproof vault in the basement that you check days or weeks later to see what survived. You do not seek shelter in the vault while the fire is actively raging. You get out of the building using the most immediate, frictionless path available.
I accept the fire drill analogy for the first 48 hours of a crisis. It perfectly describes the panic phase. But the life cycle of a macroeconomic shock lasts much longer than the initial scramble for the exits. Which brings us to the 2008 to 2011 repricing arc. This historical sequence proves why analyzing gold strictly through the lens of a 48-hour fire drill misses the ultimate monetary value of the asset.
Okay, let's hear it.
In late 2008, amid the broad, indiscriminate liquidation of the global financial crisis, gold initially struggled. As Lehman Brothers collapsed and the credit markets froze, allocators faced the same margin calls we have been discussing. Gold dropped under $900 an ounce. If you stop your analysis there and judge the asset solely on its performance during the acute fire drill, you would conclude gold failed.
Because in the acute phase of 2008, the dollar was the only thing that mattered.
Precisely. But what happened next? As quantitative easing spread across the globe and sovereign balance sheets began to balloon by trillions of dollars to absorb the toxic mortgage debt, the fundamental frame of the crisis changed. It transitioned from an acute liquidity event, a fire drill, into a protracted monetary regime event. As trust in fiat discipline weakened globally, gold rallied massively. It broke out of its slump and surged to above $1,900 an ounce by 2011. The asset did not fail in 2008. The timeline of its usefulness was simply misunderstood by impatient capital.
But that assumes we get that same massive monetary expansion every time.
Well, to understand why that timeline is compressing today, and why the ultimate structural floor under gold is so powerful, we have to look at the staggering structural demand underneath the physical market. We are talking about sovereign math. Central banks are currently buying roughly 60 tons of gold per month.
It is.
It is. Let us look at the exact historical accumulation. Central banks purchased 1,037 tons in 2022. They followed that with a record 1,136 tons in 2023. We must separate this action from the speculative froth you mentioned earlier. This base layer of demand is entirely distinct from the $10.5 billion in ETF inflows we saw in early 2026. This is not day trader, tourist money executing a quick momentum play on a brokerage app. This is strategic reserve diversification driven by sophisticated sovereign entities.
But what is their primary motive for that accumulation? I mean, is it purely economic return?
No, their motive is geopolitical self-preservation. Sanctions risk has fundamentally altered how nations manage their sovereign reserves. Following the weaponization of the dollar system over the last decade, non-allied nations have a profound desire for neutral reserve assets that carry absolutely no sovereign credit risk. A physical gold bar in a domestic vault cannot be sanctioned, frozen, or zeroed out by a foreign treasury department.
That's undeniable.
Furthermore, we must contextualize the sovereign buying against the stark fiscal reality of the United States. U.S. national debt has exceeded $34 trillion. The structural deficit shows absolutely no sign of reversing, regardless of the political regime in Washington. When major Wall Street institutions issue price targets for gold ranging from $5,700 to $7,200, these projections are not built on transient war panic. They are modeled on this long-run fiscal drift, the mathematical inevitability of financial repression, where inflation is allowed to run slightly hotter than interest rates to slowly inflate away the debt burden, and the sheer, unrelenting scale of sovereign accumulation.
The central bank accumulation is a valid structural floor. I do not dispute the tonnage numbers. Those are facts. But by introducing the sovereign math, you are actually proving my point regarding the wild card of behavioral finance. This reveals a massive category mistake made by the broader market.
What mistake is that?
The real analytical error investors consistently make is treating a war hedge, a liquidity hedge, and an inflation hedge as the exact same thing. They use the word hedge as a blanket term, failing to realize these are categorically different instruments required for entirely different phases of a macroeconomic shock.
Okay, I see where you're going with this.
Right, so when we analyze the specific transmission mechanism of the February 2026 shock, it becomes painfully clear why the supposedly timeless response, gold, failed so spectacularly, while the old-fashioned response, energy, worked flawlessly. Let us break down the exact nature of the Iran shock. This was a regionally contained war that was heavily inflationary due to the direct threat to global oil supply. Because it was fundamentally inflationary, bonds did not rescue portfolios. The inflation expectations caused nominal yields to rise, which mathematically crushed duration-heavy bond portfolios.
True, duration was a widowmaker there.
Exactly.
And because the shock demanded immediate liquidity to cover margin calls across failing equity and bond books, gold was systematically liquidated. But energy-linked equities provided the cleanest, most direct exposure to the actual underlying economic transmission of the shock. If oil goes up because the Strait of Hormuz is threatened, companies that pull oil out of the ground in North America become instantly more valuable. That is why energy equities performed dynamically while the traditional safe havens correlated towards zero.
That distinction between the specific nature of the shocks is incredibly precise. We have to separate the first 48 hours of a crisis from the next 6 months and the next 2 years. It operates very much like the narrative structure of a spy thriller.
A spy thriller? Yeah. Think about how a classic espionage film is paced. The hero appears utterly defeated in the first act. They are beaten, captured, and written off by the audience. But they only return to triumph in the third act when the deeper, more complex plot is finally revealed. In the first act of the February 2026 crisis, gold was battered by the dollar strength and the real yield spike. The surface-level plot was military conflict and localized inflation, but the deeper plot, the fiscal unsustainability of the $34 trillion debt, the eventual need for central banks to monetarily accommodate those higher debt burdens to prevent sovereign default remains completely intact.
So it's a pacing issue.
Exactly. The initial defeat of the asset is merely a function of market microstructure clearing out the weak hands, the tourists. It is not a repudiation of its terminal value.
Well, if we are going to apply this understanding to actionable market mechanics, we must walk meticulously through the exact portfolio playbook that sophisticated capital is deploying in the wake of this shock. We have the data, we have the historical precedents, so how does an allocator actually build a defense mechanism?
Let's lay out the steps.
The first mandate is to secure the immediate crisis hedge. Allocators must completely replace the antiquated one-asset war hedge concept. The first layer of defense must be allocated to USD cash and short treasuries. Instruments like the SHY or VGSH ETFs, which strictly hold short-term treasury bills, serve this purpose perfectly.
Because they are basically cash equivalents.
Exactly. The data dictates this sequence. We reiterate that the DXY rose from 97 to 100, while gold fell 20%. You simply cannot argue with the liquidity preference of the global settlement layer. When the system demands cash, you must hold instruments that function identically to cash.
Right, and then moving down that hierarchy, the second step is the application of conditional duration. You add longer treasuries to the portfolio, perhaps utilizing instruments like TIPS, which are Treasury inflation-protected securities, or standard long-duration bonds, but you do this only if the crisis morphs into a definitive growth scare.
That is a crucial distinction.
It is. In the Iran episode,
Because the shock was fundamentally inflationary through the oil channel, the Federal Reserve maintaining rates at 3.50% to 3.75% undermined the protective capability of bonds. Duration only protects your portfolio when central banks are forced to actively cut rates to stimulate a contracting economy. If the central bank holds rates high to fight inflation, duration will bleed your portfolio dry.
Precisely, which leads to the third step, identifying the actual shock hedge based on the specific transmission mechanism. For Middle East crises specifically, the transmission mechanism is almost always petroleum. Therefore, the portfolio must hold energy stocks. The empirical evidence from this exact event is undeniable. While gold was crashing 20%, energy sector equities returned exactly plus 25% to plus 30% during the shock.
Those are huge numbers during a panic.
Unprecedented spread. By holding energy equities, allocators isolated the specific geopolitical variable, the threat to oil supply, without being dragged down by the broader liquidity drain affecting non-yielding collateral.
And this is where we reintegrate the precious metal into the framework. Step 4 defines gold strictly as a post-flush add. An allocator should reassess gold upward toward a market weight or modest overweight allocation only if two specific macroeconomic conditions are explicitly met. First, the DXY must fall below 98 on a sustained basis.
Below 98, right.
That metric indicates that the acute dollar liquidity squeeze in the global plumbing has passed, and capital is no longer hoarding greenbacks simply to survive. Or second, the Federal Reserve clearly pivots to a dovish stance, indicating rate cuts are imminent, which would subsequently collapse real yields and remove the opportunity cost of holding a non-yielding asset. Until those specific thresholds are breached, gold remains highly vulnerable to further margin call liquidations.
Step 5 is perhaps the most critical for basic institutional risk management, respecting positioning risk. Portfolios must systematically avoid chasing parabolic runs. We must constantly remind ourselves of the setup that preceded the collapse, a 66% gain in the preceding year and $10.5 billion in flows across January and February.
The tourist money.
Right. When an asset becomes a consensus trade, when every retail and institutional allocator is sitting on the exact same side of the boat, the marginal buyer is entirely exhausted. At that point, the asset becomes extraordinarily vulnerable to forced liquidation, regardless of how supportive the underlying macroeconomic backdrop might appear.
Finally, Step 6 governs the strategic allocation. Despite the severe tactical volatility we witnessed in February, a portfolio should maintain exactly a 5% to 7% strategic gold exposure. This allocation is not for tactical war trading. You're not buying it to flip it when a headline hits. This is the core allocation designed for long-term sovereign risk hedging and protection against ultimate fiat debasement. It sits quietly at the foundation of the portfolio, ignoring the 48-hour fire drills, patiently waiting for the broader monetary regime shifts to materialize.
We have arrived at a shared framework here. Gold's safe haven status isn't permanently destroyed by the February 2026 events, but it is strictly conditional now. The market has permanently evolved beyond simplistic rules of thumb and ancient commodity lore. The new, highly sophisticated market sequence is established. First liquidity, then duration, then gold.
That sequence perfectly encapsulates the modern financial architecture. It forces us to recognize that the flaw was not in the asset itself, but in the expectations placed upon it by outdated models. To distill the entirety of this analysis down to its core truth, quoting the research verbatim, gold didn't break. Your crisis playbook did.
If the dollar standard is the ultimate first responder today, what happens to this entire hierarchy if the architecture of the U.S. debt market itself becomes the source of the next crisis? This is the research desk officially signing off.